We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. We're back in the SMI studio. I'm Gabe Johansson here with Trevor Howard.
Wait, this is Mike the Deal Junkies
and
studio.
I'm Dane McKinney.
Well, write me a check for it then.
We already did. We paid for the first year of the podcast. You're welcome.
Dane McKinney and Mike Nuss. Trevor Howard. Thanks for interrupting our intro, Trevor.
You're welcome. Anytime.
Pissing on his territory over there.
This is the Deal Junkies podcast studio.
No one else has ever recorded anything
until after this. Jan's going to come in and record an episode.
It'll be the Jan Johansson,
the comeback seat.
Studio.
No,
the Johansson studio.
Tanya Russell's comeback seat.
That's just the King Deal Junkie giving back to a support system.
Got to help out, man.
Dude, you wouldn't be here if it weren't for Jan.
That's right.
You'd be like, I wouldn't even want to think where you're at without Jan.
Behind every good man
is a great woman.
All right, so today we want to talk about. Do we really want to talk about
death and debt,
death and debt, and death and taxes?
We're not talking about taxes, although California is a great place.
We
to
should
die.
talk about Dane's new finding on.
We could talk about that. Yeah.
Let's start with this because this is kind of crazy. Dane, break this down.
Okay,
to the best you can.
I will. So, because I had to read about it a lot. So, you guys know how taxes work, correct? With real estate and passive versus active write-offs?
Mm-hmm.
And
like depreciation?
Yeah. And like what you can count as active versus
using passive against active?
Yeah. So like if you're a real estate professional, if you invest in a syndication, you can use that depreciation to write off like your active income as a real estate professional.
Sure, but investing in that syndication does not qualify you for a real estate professional.
No, correct. But if you already are, and then you invest in a syndication, then you can write off that depreciation, is what I thought until last
week. That's what everyone advertises.
That's what everybody thought it was or thinks it is. I don't know. I guess CPAs probably don't. But...
And you have to be active in that investment.
Yeah, you can't be an LP. You have to be a GP.
But even if you're a real estate professional,
so why does everyone's K1 distribute that depreciation then?
Well, so it won't to your active income. It can still depreciate towards passive investments.
The K1 is just going out,
the
and
K1
it will,
is just
but
saying,
still it comes down to you.
But it won't trickle to your active income. So, like, if say you're a broker and you're making whatever $500,000 a year, you're a really good broker, and you're a real estate professional. You have active investments, and then you invest passively in a deal. That that depreciation can't be used to write off your active income.
Yeah, can it be used to write off your other passive income outside of that syndication?
Yeah, and so that's the example that was given as like the main benefit is if you're a real estate. Well, the real estate professional piece doesn't matter at that point. It's if you have multiple passive investments, and like as an example, you invest $100,000 into syndications or anything passively every year, and then 5 years down the road you're exiting your first syndication and you sell it. You've just been storing up all this depreciation that then can be applied towards the gain that you have on syndication number one.
That deal in a vacuum.
Correct. Yeah. And so, but it has to all be passive.
It's going forward.
Correct. And so it carries over to the next year.
Yeah.
And so for a lot of people.
And actually, effectively, that's better because in the sale, you're going to have a higher amount. You're just going to get flooded with gains.
Yeah.
Unless you've used some of that towards your other passive income.
From the properties. Right. Yeah. And so, but a lot of times.
If you're a real estate professional, you probably don't need it because you already have active. You need it against your active, not your passive.
Yeah, that's what everybody's going for when they file as a real estate professional. They're trying to cover up their active income.
Not everybody. I'm really glad I don't raise money based on depreciation.
Well, you don't raise money on that, but it's still a benefit. It's like the cherry.
Well, I
on
agree,
top, right?
But it's not in a syndication. It is in JVs.
Well, it can be in a syndication, but it just depends on the person. Right? And that's why I was saying, like, if you invest in 5 different syndications and you know you're going to sell one, then you might invest in a
just for that syndication
for that year to get bonus depreciation to write off.
So now it's very strategic about timing. That makes a whole lot of sense. I'm working with an individual and his tax professional. I don't say her name because I don't want to flood her, because I want to give her referrals. Amazing. And I just uncovered this, and it was, really? You shouldn't be investing in a syndication. You need to be in a JV with active membership, making active decisions.
Yeah.
And then now you can use it against your business.
And so that's what I was going to say too, is because the reason this came up was because I had an investor who is a very, very high income earner in California. And so that's bad. That's a bad combination of things. The final large portion of his income beyond $500,000, which is a lot, is taxed at like 50%. And I was pitching him on a pretty large investment as a joint venture. And he was explaining like, hey, reviewed this with my CPA. I don't think it's going to work because my main goal of investing in real estate is not creating like wealth or getting any sort of income from the real estate.
Just tax
it's to write off my W-2 income. And they are actively involved in all the projects in California. And his wife is a real estate professional. She actually is. And so he was like, but if we were to invest in Oregon and you guys were, even if we were in a joint venture structure, if you guys were the managing member, which more than likely you would be, and we couldn't prove that we had an active, like...
You need voting rights. I mean...
He was like, even if you have voting rights, though, because that's what I brought up. Like, I was going back and forth.
You just put controls over the managing member, right? And you make them low enough that it requires decisions.
I agree with you guys, like, frankly, but... To his point, like he's been audited more than once.
Do you think one litmus test might be if they sign on the debt, like if they're at over 20% and they sign on the debt, regardless of your entity structure, they're considered an active investor at that point. So if you're not,
I would think so.
That's probably a good gauge. Is if you're not on the debt, you're probably passive.
Yeah,
and that is a very common conversation.
Initially, when I pitched it, I said, "Hey, the lender that we're working with, I think like we can structure it to where you don't even have to sign on the debt." And I think that was like not a good thing in his mind. He was like, well, that's like one piece that we kind of need just to, because everything else they're buying, they're signing on the debt. And so he was like, it doesn't. So then whatever, I read about all this, and like a month later I was like, hey, I think maybe it'll work if we do it this way. And I'm waiting for a response still. But I was like, I thought that I understood it. And because he's not like, well, he owns more real estate than probably us, frankly. But he's not like it's not his day job. His day job's something totally different.
It's a tax shelter.
It's a tax, it's a tax play. But obviously his CPA knew more than me. Not surprising at all. But I was still just like, it was surprising that that's how the code's written, because I don't think anybody advertises it like that.
It's not surprising that's the way the code's written. I think that makes sense. Because right? You're not being active, so you can't use this passive loss against active income.
Yeah.
Like that's the intent of the code. I think it's really easy for us to not know, because it's new information to me as well, just because there's so many layers of qualification.
Yeah.
And we tend to focus on one or two qualifications and not every single layer. And when you're talking to people that are like, I'm selling my business for $10 million, they're hiring people that look at that level of detail. But if you're giving $100 grand or $50 grand to a syndication based on an influencer, and you have $500K and some real estate, do you look at that level of the parameters?
You probably don't have a CPA that knows to.
Right.
So you're saying in the K1s, then the depreciation would flow to you. Your CPA just wouldn't be able to use it.
It would store up.
It would store up. So you just store it up.
It carries over. And I don't really know how. I think it carries over in perpetuity.
Isn't there a way also you could structure that to where, you can give your partners more depreciation if it wasn't interesting for him to have more cash flow or appreciation?
If you're in an LLC together,
you could set up a company specifically for that reason, to where we can bring him in.
Well, and this is where it's really important to know where your investors are getting their income from. So like if you have people that are in oil and gas and they have sales coming, like there's a whole nother, I don't even understand this, but if the play is I need this depreciation for this certain year, not for this investment, but for this other thing that's cashing in, well, that's where now understanding what are you invested in, why are you invested in it, how is it maturing, how does that flow into your cash flow, into your various tax returns, that's where it gets really exciting, because now you start having levels of conversation with people at this detail in a goal to then collaborate on a piece of real estate. You then become significantly better in how you see the patterns fit and how you can then put the puzzle together.
You become more valuable. Yeah.
Significantly.
Also on oil and gas, fun fact, the write-offs that come from oil and gas investments do apply to your active income, even if you're not
that's
like
the
an
biggest
active
conversation.
And that's like a weird little IRS loophole. Yeah, it's not necessarily a loophole. I think the incentive is from what I read, the incentive is to like onshore all the oil and gas industry, and then also because it's considered a high risk investment. And so even if you're not like actively involved in the business, quote unquote, because it's higher risk, you get to write off the depreciation immediately towards your active income. So it's just like a bonus
Is
incentive.
this when you're like investing in oil drilling and things like this?
Yeah, drilling. Yeah.
Did this come out of COVID when they needed money to go into oil?
I don't know when the code came through. I read the code like 2 weeks ago.
All I know is I never really heard about it in 18, 19, 20. Maybe it's the people I was talking to. But now that is the number one conversation for wealthy people trying to hide their taxes or, protect their
avoid them.
Limit them.
Legally avoid them. Yeah.
Reduce them. Kick them down the curb.
I'm just glad you added the third D. We have death, debt, and depreciation.
Yeah.
And depression.
And depression.
And appreciation.
Trevor, do you want to talk about debt?
Yeah.
You're bored of
interesting bank note. So Jordan called me we're doing our end of year taxes. Jordan's one of our partners. So Jordan called me. He's like, hey, we bought a 58 unit with him or something. And the bank won't give him.
We bought a 58 unit with Jordan?
Portfolio.
Different one. Other Jordan.
Oh.
Yeah, other Jordan. And the bank, he called me because he's like, hey, man, the bank won't give me any information about the property this year. We've owned the property for like 4 years with them. And the contact said now he can't give him any info because he's not signed on the debt on the property. And he's like a 35% owner. And I'm like, pretty sure you did sign on the debt with us. This hasn't been a problem for the last 3 years. Like, I'm not sure what's going on. And the bank's like, no, we can't talk to you about this deal. And he's like, I'm on title right here. Like, what do you mean you can't?
So funny.
And then they're requesting the documents from him. And he's like, I need you guys to give me some of this information to produce this for you. And like, we can't, but we need this from you. And I was just like, what?
I just went
so
through the
banks
same
are
process.
crazy.
I just went through
so
the exact same
funny.
process.
So teach us about debt, Trevor. I liked what you said before the show when you said trying to go out and get your own loan is like trying to perform surgery on yourself.
Yes, I've been getting a lot of calls lately about people having problems with financing and they don't know how to finance because it's a lot of work to go understand like all these banking relationships and what debt structures you should use on specific projects. And we used to do it all for ourselves, so we have a lot of information about it, and we just do this every day. But even we do not do our own debt. We use a debt broker. We use Sean with Open Door Capital, and he does all of our debt because it's a full-time job. And if you're a newbie trying to do that, you will not know what the best debt is. So all these people call me, and my solution is just call Sean, and he will handle this for you and save you time, money, effort, energy. And they're all opposed to doing it because they think they have to pay for it. And sometimes you do have to pay some for it.
Worth every penny.
Yeah, but a lot of the time the debt broker is parring their fee, meaning the bank pays the fee. So like the bank's charging a point, they waive that point and just pay the debt broker that point.
Yeah.
Yeah, so it's a free service a lot of the time. Or you can just tell the debt broker if you're really that concerned about it, I only want debt where I get my fee parred. And like people are trying to go do this thing that they don't understand. And like the person who called me is ending up with 7.5% debt. And I'm like, you can go get 6% debt with this debt broker and stop slamming your head against the wall and stop dealing with these banks that don't know like your deal or what's happening because he just pre-flights it because he does this every single day. He's doing 30 loans a month.
Yeah, I have some partners that enjoy the debt brokerage part of it. They're really, really, really smart people. They have banking relationships and they understand how to pair up an asset to the borrower, to the area, to the lender. They know how to piece that puzzle together, and then they know how to negotiate with lenders. The problem is the average person, including myself, I don't know how to talk to a bank. I don't know how to go find, it's like a needle in a haystack. There are thousands of lenders you could go to on a property. The chances that you're going to pick the very best one for your situation, to me, is astronomically rare. Like you may have a wonderful relationship. I have several lenders where I have a great relationship with them. I'll close a loan with them, and I'll think, I don't really need a broker on the next one. Hey, let's just rinse and repeat. We're doing the same deal down the street. Let's do the same deal. And they won't do that deal. It's like, I don't know the ebb and flow of how the money comes in.
Their liquidity positions change.
Well, and not only that, but like one day their bucket's not full on that asset type or that area or that borrower or whatever. And the very next day you can't do the exact same loan because they're like, oh, our CEO says we're tapped out in that bucket. We got to switch over to something else. So to have somebody out there that is advocating for you, that understands your financial picture, understands you as a borrower, which lenders are going to like you, which lenders are going to like that asset, which lenders like that area. I mean, there's so many variables that are in there. To me, not using a debt broker is kind of silly.
So I'm going to do all of you guys listening a favor. If you want some debt, can do it across 50 states for you. Sean Williams, 503-724-7429.
And by the way, it's Open Door Capital Partners. You have to put the partners on there because we're not Brandon Turner.
I should what?
You should ask him
if he wants business. What do you mean?
Phone number.
Hey, he's sponsoring the show. Gladstone superstar football
Sean,
player.
I'm sending you a bill, Sean.
Oh, that's true. He was the All-State Player of the Year.
Yeah.
Can I tell you a funny story about Sean?
Yeah.
So Jan, my wife, she's a longevity specialist. I don't even know what she does anymore. Biohacking and all this other stuff.
She's Brian Johnson's coach.
She's incredibly smart. I don't understand it all, but Sean's parents hired Jan to help them out. And so part of the deal, they were going to go on the cleanse and do the whole thing. So we went and picked it up and we drove over to his parents' house. And I walked into his parents' house. I'm carrying these bags and I look on the wall and there's a picture of Sean when he was a little kid and he's crying. And it's just the funniest.
Did you take a photo of it?
So it's better than that. I took a photo of it and I made it put him in my contact card on my phone. And so then everybody's asking me like, hey, I need a loan. I'm like, hey, call Sean.
And you send them the contact card.
I sent him the contact card. I didn't realize that it sent my picture from my phone to them. Yeah. They're like, whoa, that's the best contact card photo I've ever seen. So I had to go in the other day and change it. I'm like, sorry, Sean, I've been sending everybody your picture when you were a little kid crying on the football field or whatever he was doing. It's an awesome picture.
You should have left it. That's more memorable.
That's hilarious. All right, other side of the coin, because probably I get 90 to 90% of my loans for myself.
Because you're the type of loan you're doing.
Correct. Yeah. So the scale matters, what you're trying to do. But what makes it effective for me to be my own debt broker is because I understand all the financial statements and how they tie together. And I think people don't understand the actual underwriting process because they think of one thing is, oh, well, it's worth this. Great. Oh, it has this much gross income. Great. What's the net income? Oh, it's whatever, 1 unit loan. Or a restaurant, or a multifamily 5+, and then they don't understand the real estate schedule, and they look at, oh, well, this deal is great. It has a 1.9 DSCR, but your global is 1.2, and they don't understand. Well, I have plenty of money in the bank for the down payment. Yeah, but you have no payments.
But this is what a debt broker does.
Correct, but what I'm trying to get at is you're doing loan sizes that makes sense and it can do that for you. But if you're smaller and you're not at scale, understanding this to get the process going so you can get momentum, because you have the luxury of having a big balance sheet that now people can use. But if you're on the first end of that, they probably can't go get debt broker debt at 6%, right? They don't have any experience. If they don't have a KP, they're going to be underwritten completely different. And so the context that you're saying the statement in, while it's true, it's not always the best.
He will tell you all these things.
Correct.
Though.
And you don't run away from that, and you should go do that. But you need to understand who you are so you can competently communicate with that human being. They can educate you, so don't shy away from it. Absolutely.
I will make one comment about this is just like any industry, all debt brokers are not created equal.
True.
There are a lot of good debt brokers out there that really understand how to underwrite a deal, but they don't know how to underwrite the borrower.
Yes.
And so this comes down to, like, we have this conversation, Paul Curley and I, all the time, because people look at Paul and they're like, we don't even know where to start.
Correct.
I mean, he has $500 million in assets and nobody can figure out which way is up. And so it takes, for him, he has to have very specific debt brokers that he's worked with for a long time that have actually helped him piece together his financials in a way to where he's easier to underwrite and they can actually explain him. But just like if he were to walk into a bank, we're doing a loan right now, and the lender is literally like, let's kick Paul off and leave Gabe on. I'm like, hey, Paul, I'm going to be your co-signer. Because they just look at it and they go like, yeah, Paul's worth a lot more, but we can understand Gabe. We don't have the team to sit down and figure out Paul, right? And so if you're going to use a debt broker, we end up using a couple of different ones, but we've had others in the past, and it was like they could understand the deal and they could understand how to match the deal up with the right lender, but then it was harder for them sometimes to underwrite us as the borrower. And so just like when you're building your team, when we say you got to have contractors, you got to have managers, you got to have all these things in order to run a real estate portfolio, one of those people on your team should be a debt broker. I think that you at least have somebody to bounce off of. You may, like in the SMI fund management company, we'll go out and we'll have Sean shop some loans. We'll have some other debt brokers shop some loans. And then oftentimes Logan will go, hey, I appreciate you guys on these ones, but on these deals, I'm going to take these and I'm going to run with them because he already knows where he wants to go. And that's fine, because Logan could be the best debt broker on the planet if that's what he decided he wanted to do for a living. Not everybody is Logan. That's the point.
He's just wired that way.
Yeah, we call him the lender whisperer because like he knows how to talk to a bank and show them the reason why they want to do a loan and why. I mean, he'll negotiate everything, rates and terms and LTV and the whole thing, and most people look at that and they go like, you can do that? Like, I didn't even know that was possible. I thought you just ran around and looked for banks and they give you a term sheet and you pick the best one. But I mean, you can actually, if you have the right lender and you have the right relationship, lenders will negotiate a loan the same way you can negotiate.
Do you know what's crazy? We do loans with one bank and they don't give term sheets.
Yeah,
that happens a lot.
They don't like that. We don't give term sheets.
Or it'll be like 5 days before closing, you finally get a term sheet.
Trevor kept asking me for a term sheet, and I was like, they said they don't give them. And he was like, we need to see one. And I was like, I don't know how.
It used to be an LOI. You'd wait to get an LOI right out of the gate, and you make your good faith deposits and all that.
No, you make all your deposits with no term sheet. They'll email you your terms. So like, we don't give you a term sheet.
Yeah, they were like, well, and that's the thing is they were like, yeah, kind of probably broadly look like this, and the terms were way worse on the loan.
There are some lenders also that won't even start your third-party reports until you're approved, and they do the approval up front.
Yeah.
And so, like, I've had a couple of lenders where I've been pressing them, like, hey, we got to get this rolling. Let's order appraisal. And they're like, nope, we're not even going to do that until we have you fully approved. So they'll underwrite the whole thing up front. So every lender is different.
And be aware of the bank that wants you to deposit $5,000 so they can order an appraisal.
I've actually begged them to let me do it. I'm like, I don't care if you approve the loan or not. I can always assign that appraisal to somebody else. I just want to get this thing rolling.
That's the big thing, is making sure that your appraisal is assignable, and you do it with an appraisal company that other banks will accept.
Use.
Yeah, because otherwise you're just buying multiple appraisals.
Yeah.
For no reason.
On the note of Paul as well, and Paul is obviously a very, very good borrower. I think that we've gotten better about banks need a list of things. Don't send them more than that. Like Paul, I mean, Paul asked me to help him with just a quick refi on a fourplex that he had. And so I was working with one of the guys that I knew could give him a quick loan. And they asked him for liquidity, and Paul sent me 72 bank statements.
All in one file.
So, yeah, it was one file, though. So I was just like, here you go. And then they were like, the lender reached back out to me and he was like, I'm going to pretend I didn't see this. Can you just send me one of these that works, please? Like, this is not helpful. This makes it way worse.
You know, honestly, that's one of the reasons why I love having a debt broker, is because they act as a filter.
And that's
because
what this
they know what the banks need to see and what they don't need to see. And I just tend to just do like, here's everything, you figure it out. But you give it to a debt broker and they can go like, hey, let's weed through this and make sure we're giving them what they're asking for.
Yeah.
So that we're not providing a whole bunch of extra info that they're going to have to dig through. And it can, I mean, isn't that weird that you'd think that I have 72 bank accounts and somehow that's going to hinder my ability to get a loan? Just send me one bank statement.
Hey, these all have quite a bit of money in them. If you just want to look through them, I don't know, like whatever. And it makes it worse. But
they have ADHD, dude. You just can't do that to them.
Yeah. And it was like, it wasn't the actual lender. It was just like his assistant who was like, I don't know what to do with this. And then the lender himself was like, dude, come on. I was like, my bad. It's not me.
Dane, is
like,
this trying to drop a mic on somebody or worse?
I was like, dude, this isn't mine. Like, I'm not doing this. But, and to that point, like, you're not disclosing information. You're just actually giving them only the information that they need. And so it's not like you're trying to hide anything.
When. You got to have discernment. There's going to be banks that you just don't want to show them everything. They don't need it. And then there's ones where you need to deliver a package.
Yeah. Yeah.
At the end of the day, the lender's job is to give you a loan. I mean, they want you to succeed. Like, they don't want to do all that work to not do a loan. So they will help you. I mean, they're bound by regulation and other things. And so I think it's just important, like, they're trying to build a file, but they're not an auditor themselves. They're just trying to not get audited. They're just trying to piece together the puzzle so that they can say, we put together a healthy loan. This all makes sense. We've underwritten the asset. We've underwritten the borrower. Let's fund the deal. So what is lending like right now?
Easy peasy. And then banks are going out on one end. I think we're actually seeing the big roll up, right? Like we talked about Chase is back in the market, and now there's rumors of other people that are not lending. That's exactly what we talked about years ago.
We're seeing several lenders that I haven't even seen in the market in over 10 years coming back in. And
think of it this way. If you're a local bank and you're struggling for deposits and you're just struggling to make loans, and it's so risky to make loans, and now the big brother just comes in and undercuts you, where do you want to put your resources? Where's the best use of your time, energy, and effort? Like, you're competing with something that's really hard to compete with. That adds more risk to what you're trying to do. And so it's almost like a market share positioning that comes with the shift of capital placement.
Okay.
Then if you think about, $200 billion of mortgage-backed securities were purchased.
Did that actually happen?
It started to. That first day, $3 billion were purchased. So I don't know how much has followed through, but that's just more mortgage money. Where is it going to go? Well, I don't know. Commercial-backed securities make sense. Chase is lending again. We have good underwriting. We have deep pockets. So maybe we should allocate more money into this world. Oh.
What are you seeing, Trevor?
I mean, it's a spread. So like, we're looking at a lot of construction deals right now, and you can get as low as a 5.9% rate IO on construction, up to like a 15 on the same deal with different banks. And so like, it's important to like be checked. Like, that's why we use the debt broker, right? Because they're keeping the relationships with all these banks, and they're bringing you like, hey, I just built this relationship with this bank. You have this debt. And it's like, oh, I can build at 5.9% on this deal, but I can't do this deal with what the seller wants on price and what it costs to build at 12%. And so, I mean, you can get loans. Like, I mean, I don't know. We haven't had a problem with it yet. Like, we've been able to close every single loan. Sometimes it takes going through one lender, and then they run into the liquidity problem at last minute, and then you got to go to the next. And then it's you and a seller problem. But you're always able to find debt. Is like
spreads are reasonable. It's not that you're always able to find debt. Are you able to find debt that works? And with spreads becoming more reasonable, now you can find debt that works. And then again, the way debt thinks. So on the construction side, this is the best time to lend in construction. We're coming out of pipelines. There isn't a lot of like supply and demand. 18 months from now looks really good. Mm-hmm. And so if you lend on a longer time frame for bridge, that just looks smart.
It's kind of crazy because on a lot of these bridge to perm loans we're looking at on some of these deals, the construction debt is better than the perm debt.
The perm debt, yeah.
Mm-hmm. Which is wild
because it's
shorter term debt.
Because they're worried about inflation.
Yeah, because they'll do, so it's something like, probably like 250, 275 bips over the 5-year FHLB for construction, but IO, but then like 225 bips perm on the 5-year. So it's like,
it's just the yield curve.
I would rather just hold on to this construction debt for longer, which is weird.
Works, man.
Yeah.
It's just magnified more.
Yeah, and that's different every single bank. So it depends on, I'm assuming, how much money they have and what they're personally trying to do.
Their appetite.
Do you think we're about to inflate again? I think we are.
I sure would love it if we did.
I think we've got inflation.
Like coming. Inflation across the board or inflation in real estate assets?
Both.
The bond market believes inflation's coming.
Yeah. I think that.
That's what you do. That's what I do.
What's going to be the cause of the inflation?
I think that we're about to drop rates a little quicker than we should.
Because of the Fed?
Yeah.
Why do you think the Fed's going to drop rates quicker than they should?
I think there's a lot of pressure going their way.
Yeah, but his choice wasn't as dovish. He wasn't as puppety as some of the other nominations.
Kevin Warsh.
Yeah.
They just announced this morning we're going to get a new Fed chair in May. So Jay Powell's replacement will be Kevin Warsh. He sat on the board before. He's a known entity. Yes. Everybody thinks, I believe, that Trump was only going to pick somebody that he felt like he had some control over, but could also stand in front of the Senate committee hearings and pitch that they were going to keep the Fed independent. Like, there has to be the story that the Fed is independent, but I think in reality, I think he would have only picked somebody that he feels like he has influence.
Does the president get to pick the Fed chair?
He gets to nominate them.
And then they get voted upon?
Senate.
Mm-hmm. The Senate has to approve it.
And then who determines when the Fed stops working there? Is it on a time frame?
Yeah, time frame.
Yeah, they run on a 4-year thing.
So Powell just ran to the end of his time frame?
Powell will come to the end in May, but then he'll still sit on the board for a couple more years after that. So I think they sit, I don't know how that works, but I think they sit for 4 years as chairman, and then they have another 2 years where they're on the board.
Yeah.
So it's like a 6-year assignment, but they can be the board president for 4 years, something like that.
Mm-hmm.
It's complicated.
So no more rate cuts until the new Fed chair sits, and then you think they're going to lower too fast?
I don't know if they'll lower too fast. I think that.
But you just said they were going to lower too fast, and that's why we have inflation.
That's a good point. I think they're going to lower. It's not too fast for me. No, I think they're going to lower faster than Jerome would have. But I don't think that. I don't think it'll be an aggressive. I think we'll get to the 350.
Do you think our level of descent, historic level of descent, is going to come closer in alignment, or descent to more?
You're talking about with the
voter
people who
descent.
sit on the board?
Yeah, so because the chair typically has the 8 voters that just follow what he says until the last 3 votes. We had dissents in each 3.
That'll be interesting to watch.
Yeah, because that's really what it comes down to is,
can he lead the board to follow his?
And that's Trump's lever, right? If he can't bring if there are dissents against what he wants and it's Trump's policy, then he's not bringing people in line.
You know, before we started this morning, Mike, you said something very interesting. You said you didn't even realize the Fed had a meeting this week.
Yeah.
That's a very interesting statement
for me
from Mike
to say,
Nuss.
Yeah.
And that tells you...
And I've been watching interest rates every day because we got a $4.3 million loan.
We had a group chat going with one of the big dogs at one of the Fannie lenders and a debt broker and somebody else, and Paul was asking, like, what's going to happen? Are they going to lower rates? Are they going to do this? And the comment back was like, we don't know. We don't think so, but we don't really watch the Fed anymore. Mm-hmm. Like, it went from like hyper focused every 10 minutes we need to check and see what the Fed's going to do to like, doesn't really matter.
Think of the news articles and the talking heads. How much of that is the people with the power that are going to move money put that out there and make this the talking point before and after they do move money? And so what did we see? We didn't see anything happen. All the movement in the bond market and interest rates has been completely macro-driven lately. It's been very macro-driven on policy. And so why talk about it?
Yeah, it didn't have the effect we thought it would have once they started lowering rates.
Yeah.
I mean...
And I don't mean macro policy and monetary policy. I mean macro policy at the political level. Because we're talking about more budgets, right? Now we actually have budgets that are coming out. Now we're actually talking about spending, which is the exact opposite side of the coin. So we're focused on the opposite coin of the discussion right now. Opposite side of the coin for discussion.
So what do you think, Mike? What's going to happen?
I think they will lower rates because his talking point was mostly AI and deflationary AI.
So now he has a narrative to lower rates and say, well, first off, they're saying already, even Jay Powell is saying the reason we still have inflation is because of tariffs. So they already have that little sort of like... segue into we think inflation is running hotter than we want it to be, but we believe it's because of tariffs.
Transitory.
So it's transitory, although they won't say that word anymore. That's something they'll never say.
But that's
again.
what they're saying.
But they're basically saying like this is going to bleed off sometime this year, and that inflation will come down. Now you've got a new Fed chair coming in who is saying because of AI, that's going to be deflationary.
Yeah, so when you say bleed off, it's not going to bleed, it's going to gush, right? It's going to go faster. Like the deflationary effect to inflation isn't just going to bleed off. It's going to be, now we have productivity, right? Now we've improved supply chains, we've increased efficiency, we've increased labor, we've increased income, we've increased productivity. And so now that's deflationary combined with AI and significantly more productivity.
Do you think that's already hitting the market?
Based on GDP, it is, right? Really? You can't have GDP GDP
it's a huge increase,
and not a huge inflation increase, right?
Yeah.
So that's
real.
They're estimating the next print is going to be at a 5.4 GDP.
The problem is, how can you believe in
what does that mean
right now, though?
That's total gross domestic product. So our total, what we generate, we were down at one point in like the 1%.
Yeah. But again, it's how do you analyze it? There's the biggest bets in history are being made right now from intercompany AI contracts, right? It's like this is the definition of printing money based on psychology, not monetary policy, not by fiscal policy, based on huge buckets of piles saying, I'm going to invest all this in you and you're going to invest all of it right back in me. That is printing money at the psychological level.
To me, it's risk for a major bubble.
Yeah.
It feels...
There's a new guy I've been following on social media, Nicholas Crown. He's a trader, and I just love hearing traders talk like competently, quickly, fire hose of information. And he's been comparing the denominating various indexes in dollars versus other currencies versus gold versus Bitcoin. And he's saying the stock market is trading at 50% of what it did during COVID, based on a comparison of what the real value of the dollar is compared to these other currencies. I'm doing a shitty job of explaining it.
So he's saying the stock market is underpriced.
Yeah, so that's one thing. No, overpriced. Overpriced. Okay. But he's also, so that's just one example of how he analyzes buckets of capital and he looks at things at a very high level of detail. But what I wanted to point on to your point is the risk in the AI bubble. And what we've seen happen, or as I've seen him and other people explain, is we're actually shifting out of those big 7, the Mag 7 AI caps, and now going back into the fundamental companies that would benefit from their growth and their productivity. But still, it's a matter of that shift. It's a rotation of capital going from Mag 7 into the smaller ones, back up, back down. And then who are the bets you're making on the small ones? Because that's your asymmetrical return right now.
So one of you explain to me how AI is going to drive productivity so much higher, and it's all going to happen this year.
Exactly. So your GD print to go to 3.5 and then 5.4 it's really hard to just have faith when you shut down you fire people, you shut down data, you change where the data is coming from, you impute. So that's the biggest thing about the firing and the government shutdown is you're imputing data. So much of our reports now are based off of imputed data, which is guesses, right? So how valuable are your guesses? So it's really hard to understand, is it really going to be a 5? And where does that come from? And does it feel that way? So how many jobs did Amazon just say they're going to lay off, right?
There's 16,000.
Yeah. So what's the real message? Because the message are so mixed, so mixed. And how do we analyze it?
What I can't understand is when you look at a list of all the different assets and you go like gold's at an all-time high, silver's at an all-time high, NASDAQ at an all-time high, Dow at an all-time high, like all these things. Bitcoin, I guess, isn't an all-time high, but it's pretty high. And then you get down into real estate and it's not at an all-time high. I think commercial real estate is undervalued, but it's undervalued because of interest rates, because we're so debt-driven.
Mm-hmm. Because it's so sensitive.
I listened to a podcast about the S&P and like how people make money in it over time, and the return has been, over the last 100 years, like 8 to 10% or whatever on average.
9,
yeah, and it talks about the PE ratio it's at today
is insane.
At any other time point around this
price to earning,
yeah. So so the value of the stock versus how much money it's making.
The cap rate,
which is a money, it's an inflation discussion. Like that ratio gets into the inflation discussion.
So it talks about like any time it's hovered around this rate, if you've bought it and held it for like, I think it was a 10-year period or so, you've actually lost money.
Yeah.
Mm-hmm. Like it has not made money. And then it talks about how many times it's been in those last 100 years for a single year and between the 8 to 12 range on an average return. Mm-hmm. It's almost never. It swings so high, it'll be at like 30 or negative, 20 or whatever. So like the discussion is like, how hard is it actually to make money in the S&P? And you can't just dollar cost average in and park money in there.
So the argument today would be that, in the last 100 years we haven't had AI. So we have a very kind of like Wild West, gold rush sort of thing happening right now, where this is like, they're saying this is bigger than the invention of the internet, basically.
Bigger than a .com bubble.
Yeah, this is the biggest advancement in human history.
Yeah.
Now, how do you gauge what happens in all of the markets based on this giant disruptive factor? And are they over guessing how impactful AI is going to be? That's what I'm asking. Is like,
especially when it's technology driven, and now our currency is moving to a technology driven currency base. It's so different.
Did you see that Elon just canceled the Model S and Model X, like the two models that launched Tesla? They just canceled both models to make robots.
So now
their assembly lines are switching from Model S and Model X to robots.
He's changing his supply chain to robots because it's more profitable for the business.
He said it's a sacrificial lamb. He said that we love the cars. It's great. Yeah. People like them, but we got to make robots. I mean, I don't.
What? I'm not going to doubt the way the guy looks at the data. Why would you do that?
That dude's way smarter than me.
Yeah. But that's why. So the productivity, like now robots. If he launches, if we all have a robot in our house, right? So 50%
Trevor has one. Trevor loves it. It's his favorite thing in the world.
The coolest thing I own.
He owns a Roomba.
It's not a Roomba. Apparently Roombas suck, but this thing saves so many hours. It vacuums my house every day. It auto empties. It mops the floors.
Send me a link. I need that.
Did you know I own a robot too?
Really?
Trevor.
Hey, so you old farts, really quick before we get off this conversation. What caused the .com bubble, and why was everybody invested in it? Like, what made it a bubble?
Everybody did what everyone's doing right now with AI, and they thought they overestimated, I think,
the increase in productivity.
Yeah, I don't know. I'm not an expert on this, but that's what it felt like.
I guess you were like,
I was really novice
12 at the time. Yeah.
No, I was 20.
Oh,
because 1999, I was 20 years old. I was in real estate, but didn't understand how economics worked.
Yeah,
outside of just a book level.
Yeah.
But looking back, and from now, what I can gather, it's fully psychology, and then a bubble that just burst that psychological bubble
because everybody's so excited about it.
Everyone's placing,
but it's not real. Yeah, it's not real. It's speculation.
It's speculative. Yeah.
So do you think that that's the same thing that's happening in terms of? Because I'm trying to look at it, and it's like, okay, there's all these companies that I would think have people that I know have people that are way smarter than us, and so they're placing a bet saying this is going to increase productivity enough to justify the amount of money that we're spending on it and investing in it, because it's all, I mean, there's so many people invested.
Yeah, but no one does that. People that are that smart don't just do that.
What do you mean?
That's part of their allocation, right? They will invest in these things, but they're not all.
I mean, within the companies, not the third party investors.
Yeah. Okay, the intercompany decisions of where R&D goes.
Yeah, why do they?
That's why I said, why would you question how
it's all the third party investors that are putting money into it, but then these people have to say, okay, it's my responsibility to do the best possible thing that I can with this money, right?
To their perspective, absolutely. Yeah. And that's where now, who are you giving your money to? So
Elon Musk.
Yeah, versus what's the Facebook guy? Zuckerberg. So Elon versus Zuckerberg. They're very similar, but they look at the world completely different. And they both have huge stacks of capital that are building them out in different ways. And then those perspectives and opinions are going to shape the future of literally where 80%, 90% of investment dollars go.
Mm-hmm. So I have another thing that I found out last week, which is crazy to me, that the CEO of NVIDIA, Jensen Huang, went to Oregon State.
Huh.
Why is our football team so bad? That doesn't make any sense. Everybody else who has a
He probably doesn't care about football.
That's
why.
crazy.
Football is about talent and recruiting.
Well, it's also about having a whole lot of money. Texas Tech went from being 80th in the nation to 5th because they had a big old boy with some oil money.
So he's a Beaver, but he doesn't love the Beavers.
He's a Beaver, but he's not a Beaver believer.
Yeah.
All right.
Poor Beavers. He's not a Gabe Johansson.
Anyways, but Jensen, my OSU fellow alumni, I would put ourselves on a similar playing field.
Yeah.
He's putting a whole lot of money into AI right now. So is Elon. Elon's put isn't
yeah,
that
but you're putting a whole lot of money into real estate, right? Like that's just
So you guys
double down on what you know.
You guys had some stories on death and how it messed up your deals.
Oh, you want to move on?
Yes.
You want to talk about death?
Why don't we start that as a deal episode on the next episode?
No, you can do it real quick.
I had a interesting story. I sold a property. I think I might have mentioned this before. It was crazy. We sold a property, and 2 weeks before closing, one of the buyers died.
Oh yeah.
And
you were selling.
We were trying to figure out what to do, and a week later, the head underwriter for the lender died. We had multiple deals in the SMI office that had to go on pause because they were involved with the same lender, and the underwriter died.
Oh wow!
Like it's crazy the things that I guess people do die. It is a bummer, but
so we ended
up getting it done. But
how'd you do a deal if the buyer died?
It was an estate, and they were in an exchange, and there were multiple people involved in the entity, but the head person of that estate
still
passed
did the
away.
Deal. Yeah. How'd you do a deal when the seller died?
It's different than that, and it's actually a better way to start. And I'm serious to talk about a deal episode based on death and planning and portfolio building.
Oh, we're gonna move death to the next one.
It's just got a lot of.
I don't know anybody who's died lately.
Deals.
Do you think robots will keep us from dying? Like they'll do surgery on us? Maybe
I'm banking on Brian Johnson.
They'll broker our debt for us.
Trevor said he's going to live forever, so that's exciting.
Trevor or Brian Johnson?
Trevor said that Brian Johnson told him he was going to live forever. And on that note,
the most studied human being on planet Earth.
Oh my goodness! You only have to spend $100 million, and then you can live for maybe 10
He spent
years
$75 million on one piece of equipment to measure something in his brain.
It's absurd.
To develop
Makes no sense.
Fanatics.
Want to live forever. I got a better way to live forever. It's free. If you want to know about it, reach out. All right. All right, Deal Junkies.
I love that ending, dude. I fucking love that little seed you just dropped. Well done.
We love you guys. Please share us with someone you love, and we'll see you next time.